Good. Welcome, everybody. Thank you for joining us tonight. We wanted to do a webinar on options for financing for investment real estate properties, particularly in New Hampshire. And we're going to talk about some of the new products that are out there that are available. And we'll touch a little bit on some of the older traditional conventional financing products, but really want to talk about some of the new stuff that's out there that maybe you haven't thought about. And certainly we've done seminars or webinars in the past discussing regular financing, and we can link those to you later on. Or you can check out our YouTube channel. Anyway, we're glad to have you. My name is Mark Warden with Porcupine Real Estate. I'm the business owner, and we specialize in helping out liberty-minded people in New Hampshire to own property, whether it's land, houses, investment property, or the like. We also work with a number of property managers and construction people to help you make it a great investment. What I'd like to do is let the other guests introduce themselves. Amy is here, and she's, I'm glad to see Amy on camera for a change. She's usually behind the scenes. She is our marketing director for Porcupine Real Estate. But Zack, give us a brief introduction, if you would, please, and then we'll go to Chris.
Thanks, Mark. So my name is Zack. I am a Free State native here in the great state of New Hampshire. I'm relatively new to Porcupine Real Estate, but I've been in the business for a little while. I've had a lot of good transactions, and actually recently I did a hard money transaction. So I'll be happy to talk about that when the time is right.
Thank you, Chris. If you want to unmute and just give us a quick update and background intro.
Hi, everyone. Sorry, I'm coming from my truck tonight. I had a meeting and couldn't get back in time, but my name is Chris Nadeau. I work with Lakeview Mortgage, and I'm here to help go over some other ways to obtain financing for investment properties.
Great, thank you. We're glad to have you here, along with all the people in the audience. I'm going to start a screen share here, a little bit of a slideshow, just give you an overview of what we want to talk about. But certainly we're open to questions tonight. And if you'd like to drop those in the chat box, we'll do our best to answer them during the discussion or afterwards. We're going to try to go about 30 minutes tonight to not take up too much of your time, but I think you'll enjoy this information. Chris, remind us what the typical types of financing are, and what's the most popular for investors?
For investors, is really only one type that's common, and that's conventional financing. The government insured loans like rural development, FHA, and VA, those are only for owner occupied properties. So the normal financing is just conventional financing that's generally 25% or more down.
Okay, yeah, most people are familiar with that sort of thing. But now there's this new type of loan, or it's a new product that we've called non-QM, whatever that stands for, and DSCR, whatever that stands for. You know, when our clients are interested in the property, we just send them your way. So if you'll explain to those in attendance what those acronyms mean and how it's new and better than what they had, you know, a couple of years ago to choose from.
Definitely. So non-QM just means it's not a qualified mortgage. A qualified mortgage is Fannie and Freddie's way of, if your loan meets a certain criteria, then it goes into safe harbor, which basically is a whole bunch of legal stuff that really doesn't matter for this. But non-QM means it's not part of that. In the old days, we used to call it subprime, but it's not a subprime loan. It's just not a qualifying mortgage. And then DSCR stands for debt service consolidation ratio. I believe it's consolidation, but
no,
what it
coverage,
is,
debt service coverage.
Debt service coverage. Thank you. Debt service coverage ratio. So what that is it's the reason why you can only purchase it as an investment. You're not allowed to live in the property is because it's treating it similar to a commercial loan, where if the property pays for itself, if the rents cover itself, then you qualify.
I see.
And the good thing with this is the down payment's the same. It's still 25% down. The rate's going to be a little bit higher. The fees are going to be a little bit more, but no income is used whatsoever. So if you're self-employed and you make a bunch of money and you write it down to $15 at the end of the day, or, money's just tight, as far as proving it for income wise, it's okay. They really just want to see the credit score and proof that you have had a housing payment for the last 3 years. So whether you own your own home and it's 3 years of mortgage payments, or if you pay rent to a management company, 3 years of rent payments, that's really what's involved.
Chris, when this new program came out, did it also extend to 5-unit buildings? Is that a new thing?
It did. We right now it's back to the 1 to 4 units. The company, were a couple companies that were doing them up to 5 units, and those companies aren't doing so well right now. So I'm not working with them. It's not going to do any of us any favors if we can't close a loan.
Okay, well, let's flesh that out a little bit to the people in the audience, just so we're all on the same page that almost all conventional financing, certainly anything with the FHA, USDA, that sort of thing, is going to be for a single family home or 2, 3, or 4 units in a multifamily property. And Chris can correct me, you can probably do a mixed use if it's like 3 units in a storefront. Would that qualify?
With very certain criteria, it can.
Okay.
So my
So you need to have that-
recommendation would be stay away.
Okay.
Don't search for that type of property.
Then for purely residential purposes, 1 to 4 units is most of the standardized financing products. And if you go from 5 units and above, now it's considered commercial financing or a commercial product. And the vast majority of our regular, let's say local banks and mortgage companies, mortgage brokers like Chris, they don't do that. You have to go to like a local savings and loan or a business bank like Centrix Bank or NBT. It's a totally different product. It's not a 30-year fixed loan anymore. It's usually 5 years at a time, maybe amortized over 20 years, but the rate adjusts every 5 years. The underwriting guidelines are different. So tonight we're not really getting into that, but keep in mind, if you're looking at 5 units to 55 units, let's have that discussion separately. Okay, let's just touch briefly on FHA, USDA, and VA financing and how that works if somebody wants to invest in a rental property here in New Hampshire.
So right out of the gate, USDA won't allow it. They'll only do single families. VA will allow you to purchase a 1 to 4 unit home as long as you're going to live in it. However, with VA, you cannot use rental income from the other units that you're not occupying unless you can prove that you have rental history. So if you currently own a rental property, you can buy, and you show on your taxes that you're a landlord, then you can buy a multifamily through VA and use the rental income, or your own income just has to be enough to cover the whole payment. FHA will allow you to purchase 1 to 4 units, again, as long as you're going to live in it. They have a trickier rule when you get into a 3 and a 4 unit where 75% of the rents has to cover the total mortgage. So that can get a little tricky, but that's a conversation we can have a little later in more detail, and just call me with any questions on that. But the great thing about FHA, if you're going to live in it, is it's only 3.5% down.
Okay,
Versus
so for
25%.
owner occupants, I mean, that's your best house hacking option right there. Amy, can you read the message in the chat? It seems appropriate at this moment for Chris to address that.
I do not have any messages in my chat.
Oh, maybe it's always direct to me. Sorry. Chris, it says, would occasional occupancy of a unit be allowed, like a vacation home?
It would, but it would be considered an investment property. It would not be considered an owner occupied property.
What if it's a, let's say, a 3-unit building and you live in one, either part-time or full-time, but one of the units is set up in Airbnb? Would you consider that as still a residential product for your loan purposes?
Yep. Now we might not be able to, Yes, that would be completely fine. You'd still be able to use the potential rental income off of that because we'll go with what the appraiser says market value is for that unit. And what you just, how you decide to rent out that unit as an owner, landlord owner, is completely up to you.
Okay, great. Good answer. Thank you.
So, Chris, how about when it comes to single family homes? Let's say there is a in-law unit in there. Would that count?
No, well, as far as being able to use rental income from it
Yes.
to qualify, no. Because technically an in-law is for the in-law and you're not supposed to be charging family. It's kind of what it comes down to. But unfortunately, no, we wouldn't be able to use income from that to help someone qualify to pay for the home.
So on the topic of conventional loans, how about so as for the 75%, is that also apply to conventional loans or just the FHA?
Just FHA. Conventional loans, there is no rule that states the house has to pay, the rents have to pay for the mortgage. That's just an FHA rule. It's called self-sufficiency, but that's only FHA. And it's only on 3 and 4 units for FHA. For 2 families, that calculation doesn't come into play.
Okay, the next topic, we're going to ask Zack to share his experience with us. And the topic is hard money loans. A lot of you have heard of that term, but maybe we don't know really what it means and what some of the details are. So Zack, please share with us, when would a hard money loan make sense and how's it different from the typical 30-year mortgage that Chris typically handles?
Sure. So hard money loans, they're more of a situational type of loan. It's not really a loan that you would get for a buy and hold type of strategy or a strategy where you're going to be living in one of the units. A hard money loan would really be ideal in a situation where you intend to fix up a property, rehab it, or say construct additional units or anything to do with a short-term transaction. That's where hard money really thrives. So what a hard money loan is basically it's from a private lender. It's just cash. So they're lending you their cash and they expect that you're going to pay a much higher interest rate on that cash. So some of the advantages are you can close a bit faster than if you're doing it through a mortgage company, but you're probably going to have a lot more upfront costs in the form of points. So you're going to be paying a lot more upfront and you're going to be paying a much higher interest rate. But there's a lot more flexibility generally with these loans since they are from private investors or private lenders. So it's really more about the property than it is about you. So they usually don't really need much in terms of income, or it's more about what the deal is. So if there is good potential for the property and you can show them the debt service coverage ratio and it all adds up, then you might be able to get out a hard money loan where you're transferring that or refinancing that later on into a more long-term loan. So it's for a special type of buyer, a special type of property, but it definitely can be advantageous for the right situation for sure.
Very interesting. The hard money loans, you said, are higher interest rate and points, probably more points up front. Can you give us a feel for just how high those are, what those are? Let's say if a regular mortgage product is currently 6.5%, 30-year fixed to buy an investment property. How does that compare to what hard money loan lenders would be offering in today's environment?
So I recently did a hard money loan transaction. So we did some shopping around for hard money lenders, and I was usually seeing them anywhere between 12 to 15, 16%, depending on a number of factors. So it's definitely much higher. It's not something that you should really be holding on to for long. So the idea is basically you have your entrance plan, you have your while you're holding it, you have a plan for that, and then you have an exit plan already in place. since this is not something you really want to be dragging out. It's in and out type of thing.
Very interesting. And what is the typical loan to value that those people are looking at? I assume it's a lower loan to value that they'll go compared to other types of financing.
So it's really going to depend on a number of factors, mainly the debt service coverage ratio, comparables. There's a lot of factors that are going to go into it, but in general, I usually see between 20 to 30% they'll usually want, and that's because it's a private lender. So it's usually either from a fund or it's in-house funds. So they're giving you all that money up front, and they really want to make sure that it's secured by a decent blanket. And so if you're only putting up 5-10%, then they're really at risk there. So it really has to make sense on their end, where the property does have good rentability, has good sale value. It's a good deal. So it's more property specific than lender specific for this type of for this type of financing.
Very good. I know that in Manchester, we have a pretty active New Hampshire REIA, or Real Estate Investors Association group. And there are some people in there who do hard money lending. So if that ever becomes an option for any of the people on this call or watching it later, that they feel like they need some money quick for a rehab, a flip, or if they already own more than 10 mortgages and they can't get regular financing, that's an option. Give Zach or myself a call and we can try to help you out to find somebody.
If I can piggyback on that, I've seen, several over the years, several people do hard money financing, and everything that was said is dead on. Points, they're usually 4 or 5 points added, which is 4 or 5% of the loan amount. And usually there's a balloon payment, meaning that they want all their money back within a year or two, whatever they put down for the balloon payment. There's something that we can do called delayed financing with just normal conventional financing. So let's say you find a house, the condition won't pass for normal financing. So you go and get your hard money loan, you buy it, you fix it up. And if you're going to keep it, then we can do what's called delayed financing. We just prove where the money came from, which is very easy. There's going to be a wire transfer. You're going to have the documents from the sale of the property, and we just do a refinance and pay off your hard money lender and put you into a normal conventional loan at that point. So there's options to get out of it too, if you're going to go down that road. Like Mark said, just call us and we can help guide you.
Beautiful. The opportunity there is for somebody to do a value add play on a building, particularly a fixer upper. Maybe it's half vacant. You go in there and it's disgusting. You got to fix it all up, put in new flooring, new bathrooms, new kitchen. You rehab it, and then you call Chris and say, okay, now give me a regular 30-year mortgage on it. But you needed the short-term financing just to get into the building for a quick close, and because it didn't qualify for regular financing. So that's a good option for us. Zach, there's a question in the chat about the terms for these hard money loans in regards to how many months. You mentioned interest rates and points, but is this a 30-year mortgage? Is it a 30-day mortgage? How does that work?
So it's going to depend on the lender. I don't know the specifics of in terms of what options you're going to run into, but I think I would contact some private money lenders, some hard money lenders, and see what options they have.
The general answer to that is it's typically 6 months to 12 months. The hard money lenders want to be in and out of that deal. They want their money back quickly, as do their investors. So that's the typical term. They may give you a one-time extension beyond 12 months, but they hate to go any longer than that. Okay, we have another thought here I wanted to share with you for alternative financing, following the theme. And that's to buy property within your IRA. You can shift your 401k or Roth IRA to a self-directed IRA or a qualified retirement plan. And you could actually buy a rental or income property inside that IRA. And this might be a good option for people who for example, have all their wealth tied up in the stock market. And maybe they own their personal house, but they'd like to diversify a little bit more and get out of equities. This works best if you have the IRA purchase the home for cash, the home or the multi-family property. It is allowed to have financing on IRA owned properties, but it gets real complicated from a tax standpoint. So it's best to just buy it cash through your self-directed IRA. In fact, here at Porcupine Real Estate, we have a client who's done this twice. Now, the thing is, there are some limitations and restrictions. For example, you can't take any of the revenues yourself as a dividend or put money in your pocket. Really, all the revenues have to go back into the IRA for future distribution. And you should hire a professional property manager. So it's a third-party transaction, arm's length. And you'd have to hire contractors to do all the work instead of you doing it yourself. But again, it's an option, and in an appreciating market, it works well. So our client who did it 5 years ago and bought a couple duplexes has done very well by that. And I think that appreciation is done about as well or better than his equities. But again, it's just a way to diversify and something for you to consider if you have a big corpus in your IRA. And then I think Zack had a question about that earlier. He said, okay, well, if it's in Roth IRA, self-directed IRA, then when you sell it, are the capital gains tax-free? And it's my understanding that yes, that's the case. So that's a nice bonus for doing that. But if you sell at the wrong time and the value has been flat or hasn't gone down, maybe it's not a great deal. But consult your CPA and your tax professional for more specifics. Let's go to the next slide. In our Liberty community with the Free Staters and other liberty-minded folks who are awesome, we often hear about people who have some cryptocurrency assets. And Chris is probably going to laugh at this because we have a lot of people who want to sell some Bitcoin for their down payment. And this has happened a number of times with our clients. I've sold 3 properties for Bitcoin, 2 of them 100% of the value for Bitcoin. It worked very smoothly. It was great. That's when the buyer and the seller agree to transact in the cryptocurrency. The third experience was sort of half and half. The buyer came in with half Bitcoin and half US dollars or fiat because the seller needed to pay off his mortgage and pay the title company. But there are some constantly evolving products out there with DeFi or decentralized finance. And there are ways to borrow against your crypto holdings to take out US dollars or USDC, and then use that to purchase a home or an investment property while not totally selling or liquidating your Bitcoin. So if you have a lot of wealth in cryptocurrency and you'd like Zack or me to help you with finding a property as an investment, well, let's talk offline. It's not that common right now, especially that Bitcoin is down. But when we see it go to the moon for our maxis out there, our friends who are going to see it go to 100,000 or more, well, we're going to be seeing a lot more of these transactions in the near future.
Speaking on that, I've seen a number of properties even before I was with Porcupine Real Estate where on the MLS, it'll say this property, like we accept either Bitcoin or Ethereum. I saw many of those actually.
Yeah. Porcupine Real Estate was the first brokerage here in New Hampshire to transact a sale of a house in Bitcoin. There were others, I think, before that in Miami, but we did it in 2017 and again in 2019. So it really depends on, having the right parties at the right time. Most sellers will want to get regular dollars because they don't understand the cryptocurrency thing yet. But that's always snowballing and gaining adoption. So we're going to see more and more of that in the future. Chris, if you'll briefly share with people who may have some cryptocurrency but not enough to buy a house, what do they need to do if they want to use their crypto holdings as a down payment to buy a rental property?
Sure. So it's considered the same as if you were liquidating money from 401k. So you just have to, we have to show that statement. So it has your name on it, how much you have and what that is translated into US dollars, and then see the liquidation go into your bank account.
Okay, thank you. It was a bit garbled, but
Was it?
yeah, I know you're on your cell phone in your car, but to restate it, basically, if you want to sell some crypto to pay off, to use for your down payment, you should do it 3 or 4 months in advance of the purchase. Please call me or Zack directly or talk to your lender, and we'll walk you through those steps. Next slide has to do with construction financing and renovation loans. So instead of getting a regular FHA or a conventional mortgage, 20% down, buying a house that is livable, there are options for renovation loans. Again, this would be an alternative to what your standard Fannie Mae, Freddie Mac financing products are. And Chris, I don't know how your signal is. So it sounds like you're better. So why don't you, if you just touch on a few things there, like pros, cons, and pitfalls.
Definitely. So renovation loan, rehab loan, construction financing, they're great products for certain situations. They are much, much more involved for the buyer. And that's because it's your job to coordinate the builder. And that is not as easy as it sounds. There's a lot of paperwork that the builders have to fill out, especially on a construction loan. And even on a rehab loan, it's getting the contractors to the home and having them fill out an estimate properly, which means itemizing the repairs that are going to be done for both labor and materials. And which I know it sounds easy, but you would be surprised. And I help the best I can with that. But these products come at a little bit higher, rates, a little bit higher fees, but they can be fantastic if you found your dream home and it just is not in the condition that it needs to be in, and you need to finance the repairs. And then, in this market with the rates being so high now, almost everyone is in agreement that the rates are going to dip at some point in the future, whether it's a year or 3 years, but the chance for a refi in the future is pretty good. So I wouldn't be too worried about getting into something right now like that with a slightly higher rate.
Very good. That's helpful. Thank you.
Construction loans, those are used to purchase the land and build your own home. Those are where it's really more detailed because you have to get a true general contractor. But they are available for as little as 5% down. You do need to have an awful lot of money left over. They want to see at least another 5% left over in reserves. So these loans are doable. Like I said, there's definitely more involved with them. But if you have any questions, call me and we can go over them in detail. And my connection will be much better then too. I apologize.
That's great. Thank you, Chris. And the last alternative method of financing we should touch on is something called seller financing or seller carryback. This used to be a lot more popular a couple decades ago, but we rarely see it these days anymore. Mainly, especially in a hot market like this, lenders are eager to finance, they're eager to create loans, and there are enough buyers out there where a seller can find somebody who has good financing lined up. But occasionally, what we see in New Hampshire here is a property that's been on the market for a long time and just can't sell for whatever reason. And I've been involved in a transaction like this personally. And in that case, you may, if you have a willing buyer, but he just can't get the financing, not only for his personal credit reasons, but also because the property itself may have some problems. Well, we can always ask the seller if they're willing to offer personal financing to carry a note. And a typical example would be, let's say, a rundown multifamily that just can't qualify for any kind of normal financing. The seller is desperate to sell. A buyer wants to buy it and has some cash, but maybe the buyer is self-employed and can't get the regular financing from our friend Chris. So we can structure a deal where the buyer will still come up with 10 or 20% down. And then the seller, as long as he owns the building outright and has a lot of equity, can then be a personal bank and give a note to the buyer for the other 80%. And typically that'd be a short-term loan for, let's say, 5 years, and typically at a little bit higher interest rate than you're going to get from a bank. So maybe 7, 8, 9%. But, you know, a good real estate transaction is not just price, but also is about terms. And if the price and the terms work for both parties and it's a win-win situation, then we can get to the finish line. So that's a good option for us as well. All right, well, I think that's going to wrap it up for now. I'm going to share the screen so you have our contact information. We really appreciate all of you in attendance joining us tonight. And we look forward to speaking to you individually. Chris, Zach, Amy, thank you for hosting. It's been informative and illustrative. And we want everybody to be free and find your financial well-being through real estate. Thank you for joining.